Money Show. Personal finance.
Personal Finance with Warren Ingram from Galileo Capital, and asking the question tonight and asking Warren for an answer on it. Are you looking at buying aggressively now the global markets are down? And you would have seen today that things have already crashed in the United States. It's quite nice if you're going to buy stocks there. So thinking about our markets as well, the all share below 70,000 today. So you could perhaps go and pick up a few bargains there as well. Good evening, Warren. Are you going shopping?
I think it's actually a very good time to go shopping, Ray, and I think probably more especially globally than in South Africa, where I think our market wasn't that expensive before things got a bit shaky in the last while. So South Africa is cheap already, but globally, the global markets were really expensive, especially by about November last year, and now they're starting. Well, some shares are starting to get into pretty cheap territory. So definitely, I think it is a time to start looking at buying, and it's amazing. A few phone calls this week, people phoning me and saying, do you really think it's a good time to be a buyer? Shouldn't we just wait, for the markets to kind of get over this? And once they've fallen, and things are starting to get better, Isn't that the time to be buying? And it's so fascinating because I think, that kind of human instinct, it's very understandable, and it's so easy to be a buyer of shares when markets are going up. But we need to understand that the way you buy quality shares and quality investments is when they're cheap. And unfortunately, you don't buy cheap, quality investments on the cheap when things are going up. You buy them when people are scared and people are selling in panic. And I think, we may not be in panic now, but certainly there are a lot more sellers than there are buyers of shares. So it feels like bargain hunter territory to me.
You're quite right, because, people do panic when the markets are crashing. I better sell now. But that's always the big mistake, isn't it? Then they're not understanding the markets.
Yeah, and I think it's always easy to have it as an academic conversation with someone, to say, human behavior plays itself out in markets, decade after decade. We see the same patterns over and over again. But we shouldn't lose sight of the fact that, at the end of the day, there are real investors out there that have got their, long-term retirement savings, their pensions. And I guess for them, this is not just an academic thing. This is real. They're worried about losing money permanently. And I think, it's our job, I guess, on the show to talk about this and to say it's very rare when markets are down that you lose money by staying invested. Firstly, especially if you're buying a really nicely broad and diversified portfolio of assets, whether it's an index or a kind of a global equity unit trust, it doesn't matter. Just something very diversified. The likelihood is markets fall. It's very uncomfortable. We get lots to talk about on the show, but the investor out there with real money in this, they're not going to lose money if they stay the course. And I guess watching the investments, if we look at the US. The US is down 13% for the year so far. So, you have $1 million invested in the US. You've lost 130,000 Rand, to give it real numbers. And that's a lot of money for people. And so I get it. I get that, watching things go down. And then some crazy guy on the radio says, hang on, this is a great time to be a buyer. I get that it sounds crazy, but when you zoom out again and you take a long-term kind of very big picture view, these are the times when the bargains are bought. These are the times when the clever guys with experience like Warren Buffett and the like are deploying cash to buy businesses. This is when, we see Apple, for example, announcing they're going to spend, many billions of dollars buying back their own shares. And they're not doing that because they're stupid. They're doing that because they see value now. Yeah. And I think we need to have the same attitude as investors.
But Warren, is it because they can aim properly? And I'm thinking about where are you going to invest? And Warren Buffett is not a fool whatsoever. He knows where to aim. He can sniff out a company and go, I'll buy you because you're going to be something. Is it all about aim?
It is about aim, I think. And I think if you're not an absolute expert in shares and you haven't got very deep and very broad, knowledge of stock markets and specific companies as well, then, don't be tempted to buy individual shares that have crashed. I'm thinking immediately of my favorite streaming service, Netflix. It might be something I like watching, but sure as heck not a share you want to buy right now. And the fact that it's lost so much of its value in such a short space of time doesn't necessarily mean that it's going to be a great share to buy now. So I am saying there are bargains to be had, but you want to be very careful of buying a share, individual shares in a market like this, where perhaps their business cases have been found out, or the whole market dynamic has changed on them. I'm thinking of shares like EOH and Steinhoff as well in South Africa. When they collapsed, now my phone was buzzing with people saying, shouldn't we buy? And fortunately, they didn't, because those shares collapsed even more after they decided not to buy. And so I think when you're talking about AIM, I'm going to change the analogy somewhat, because I think actually what you need to do here is aim very far and very wide. In other words, I think there's almost no danger in buying an index now. Buying a high quality world index, or a JSE index, and holding it and being very aggressive as a buyer when the index falls a lot. I think that's a really good strategy for the next 5 and 10 years. Might be a terrible idea of the next week or 3 or 2-3 months, because we don't know how far markets fall. But buying individual shares now, unless you've got really great knowledge and you can do something with your specialist knowledge, be an index buyer, or buy a general equity unit trust. This is a good time to be a buyer of those kinds of things. Maybe don't catch the individual shares, because you might actually be trying to catch a falling piano. And as we know, pianos are heavy and they squash you.
They do. You get squished if that happens to you. But I'm just thinking now, is it because you're saying this because we live in very volatile times? We've got the Ukraine war. And that's not going to finish anytime soon. You've got Western sanctions now against Russia. Russia saying, no problem, I'll just cut everything to you. So you've got Eastern sanctions now. We've got these COVID-19 figures, 9,700 plus people infected in 24 hours, 7 dead. These are not looking good. All these factors are not looking good. Is it not perhaps, Warren, like you say, okay, go for a general index, but could you not perhaps get lucky on something, because things are going to shoot up and down?
So when you say get lucky, in other words, buy an individual share that then shoots up in value.
Yeah, exactly.
Ray, I've got a very strict wife, and one thing she's taught me is, we don't rely on luck in our investment strategy, because luck goes the other way as well. So for me, hope or luck are definitely not great investment strategies. So I want to take fairly calculated, concentrated risks when I make big investment decisions, and buying an index when the markets have fallen, or buying a general equity unit trust. I feel like that's a really good, sensible, calculated risk to take now. But buying, just to use the Netflix example, buying it now, both of us, you and I, could sit here for the next hour and make really good business case as to why Netflix is going to go up or why Netflix is going to go down. The truth is, we don't have a clue. So I don't really want to rely on luck there. I'd rather be very careful and considered with my choices and my risks that I take, and avoid those individual shares. And I'm happy to miss out on profits, but I really regret the big losses. And I think that's the point here. Is you can be pretty sure buying an index is a high quality decision. You're probably not going to lose money in the next 5 and 10 years. I'm almost willing to bet that you won't. But individual shares, they can squash you, and I don't want to rely on luck to avoid the ones that squash me.
Yeah, absolutely. Do you also find, though, that certain sort of social media companies, or say, for instance, you said Netflix as well, they go through these waves? And I'm thinking about Elon Musk. He's gone on board Twitter now. Could this be his undoing if Twitter starts to deplete, and perhaps people like something else called TikTok or something else? He may have made a mistake because the wave goes down.
True, 100%. And so, very interesting, because his kind of main aim here is to take the business private, so he'll have other investors with him, but he'll take it off the stock market. And one of the reasons that's clever is because if that business starts to struggle, he might be able to buy, the other investors out if they just want to get out. They're not going to be many big buyers of that share. So, staying in the unlisted space there could work for a business like that. What we also need to know about Elon Musk is, he finds ways to kind of make his mistakes profitable. I think he's made many big mistakes, but both in Tesla and in SpaceX. And I just think about his solar business, that he's bundled into Tesla. Some of those weren't very successful to start. He broke every single promise possible when promising to deliver cars. At the start of Tesla's life, he still breaks those promises. But it's amazing how he can turn failure into success. So I think that might be a smart call. What we also know about him, he's got such deep pockets that he can kind of buy himself quite a lot of time if things change on him, and he can find potentially new revenue streams. I'm sure he's done the work already, and he'll kind of almost bully the market into a direction and bully his way into his success with Twitter. I think, having said that, my 2 cents worth is I think it's a terrible move for all of us. You don't want someone with such a big ego owning such a big megaphone. The only worst buyer for Twitter could have been Donald Trump.
That is true. That's a very good point, actually. All right, I'm going to take your wife's advice and just be a little bit safer with things. I've got a listener's question here. So it says here, Dear Warren, I'm excited because I will be retiring at the end of this year. My investments are split equally between my pension fund and unit trust investments. My aim is not to waste my capital on paying tax. The 1/3 that I'll be able to take as a lump sum from my pension will be more than R500,000 or 500,000 Rand tax-free portion. Should I take the entire 1/3 lump sum from my pension fund, or can I just take the R500,000 Rand? Is there a disadvantage if I only take the 500,000 Rand as a lump sum? This is from David. Your advice to David.
It's a very good question, because I think none of us enjoy paying tax unnecessarily. So there's tax we have to pay, and then there's tax that we choose to pay. And so, Ray, just very quickly on a little bit of background here, when you take your 1/3 of your kind of lump sum that you're allowed from your pension fund, the first 500,000 Rand of that is completely tax free. That's across all pension funds, RAs, etc. And then you're going to pay 18% tax if you take any amount over 500,000 up to 700,000. And then if you take something over 700,000, you're going to pay 27% tax on the amount over that. And I think, to stop there. So in this instance with David, if he only takes the 500,000, the other way he's going to get his pension paid to him is on a monthly basis, and it's going to be an annuity that pays him income, and that annuity will attract PAYE. And the lowest amount of tax you will pay on an annuity is going to be 18% on PAYE. So if he takes kind of up to 700,000 Rand as a lump sum from his pension, and that's still allowed within the 1/3, I think it's okay to pay that 18% tax, because it exactly matches the tax he would pay on his normal income from his annuity. So I like that idea. But beyond that, I wouldn't pay any more tax than that. I would leave it in and then just take a monthly income from the pension. To me, that makes sense. Just very quickly for David, also to know that your pension, if you leave it to your beneficiaries, it gets to them free of estate duty, free of executors' fees as well. So it is quite a nice, tax planning tool. So you don't really want to deplete it if you can help it, and you can use your other money to kind of manage taxes along the way. So I like the idea of blending my pension and my other investments as well. I think he's done well there, and perhaps don't take more than 700,000 from your lump sum.
Sure. Okay, all right. We've been talking about playing it a little bit safer tonight in a volatile climate. We've been talking about investing pensions. We also have a phrase of the week. What is liquidity risk? What is liquidity risk?
So the liquidity risk is really valid in a time like this, because you find that there are investments, which are not easy to sell, and to sell very quickly. So for example, there might be some smaller shares where there are not a lot of buyers for those shares on the stock exchange. So if you've got a big chunk of those shares and you want to sell them in a hurry, you might have to take a heck of a price knock if you do sell them, because they're just not a big pool of buyers on the other side. Similarly, if you think about trying to sell a house, you can't just sell a house tomorrow. You've got to find a buyer that's willing to pay the price you want. Otherwise, you've got to knock your price down, until you find someone that will pay the price, that they're willing to pay. So liquidity risk is about being able to sell something relatively quickly and easily. So a big share that trades on the stock exchange very easily, like a Naspers or an Anglo's, there's no liquidity risk there. There are always buyers and sellers of those shares. So the price, the difference between what a buyer wants to pay and what a seller wants to sell at will be quite small. But there will be other times when investments are illiquid, where you might find a huge gap between what buyers are willing to pay and what sellers have to get. So when markets are volatile and rocky like we're seeing now, being in very illiquid investments is not a great idea if they're going down and you don't see the prospect for them recovering, because you're going to have to sell them at a heck of a loss. So avoid liquidity risk if you can. If you can't, then you hope that what you own is a quality investment that will recover in the future.
That's so interesting, because a lot of people just think they can buy and sell and throw caution to the wind. Warren, when you're going to buy something now, and you can go into a collective fund or something like that, even a Satrix, which is quite safe. But if you don't want to do that, what are some of the big players where you should be placing your money? Maybe, like you said, Naspers, but they do go up and down with 10 cents. There's always the old Apple or the big hitters. What would you do?
I'm a complete fan of, always have been, of Warren Buffett. So I think, looking at a share like Berkshire Hathaway, which him and his team manage, I think it's almost like a unit trust on its own, because it's a really high quality business that owns like a collection of fabulous companies. Not all of them are listed. In fact, most of them aren't, and they're sitting on an enormous amount of cash. So I think they're going to be buying a lot of quality businesses now at a really big discount. So I always think, Berkshire is a great share to buy if you're looking for something very diversified. And then, Ray, you can't take away my beloved index investing either. I think, you have to consider that as a big chunk of your investments as well. But if you're looking for kind of a big stock tip, I know it's not a unique one, but I think Berkshire in a time like this is a great thing to buy. And I think, just buying that sort of broader tech index in time will be a good call. I'm not rushing into it now, but I think not a bad idea either.
Interesting WhatsApp here says, good day, Ray. Can you ask Warren how one can buy Shoprite shares without going through the JSE or as an individual? Can that happen? How can you actually just buy shares straight? Not sure if you can do that.
I don't think it's. Yeah, I don't think it's possible, Ray. And I think you can use, you can use a platform like, Easy Equities, where you can buy fractions of the shares, but ultimately it is going to go through the JSE, and that really is the only way. I think, and if you like Shoprite, buy it. I think it's not a bad share.
Yeah, it's a bit of a strange question, actually, because you have to go through the JSE. So, Warren, where do you see things going when I'm talking investment-wise over the next couple of years? Or is it just is everything just topsy-turvy? In fact, Bongani Bingwa this morning was basically saying, we're just going through horrible times. We're going through really awful times. And I think he was right. Like humanity, everything is just not working out well at the moment.
So Ray, that's absolutely music to my ears. That's exactly the set of conditions you want to hear when you're a share investor and you want to buy quality shares at a really nice discount. I didn't hear Bongani this morning, but that fills my heart with love and joy, because I think I don't like buying shares when markets are pumping and everyone's optimistic and happy, and because what it means is everything's expensive, Ray. And I think right now, I'm not saying everything is dirt cheap, but what we need to understand is the world turns, this too shall pass. I know sometimes it's painful when things pass, but what you need to know is that investment markets have been through much worse than what we're seeing right now.
Yeah.
And once markets understand what's going on and we get used to these conditions, the big issue for me, if you really want to know, is not the things that you mentioned at the start of our conversation. It's really about interest rates rising too quickly in America. That's a big threat, and inflation across the developed world. But that will get absorbed and move out of the system. And I think we are buying things now. We should be buying things now, all of us, that have good businesses with sound business cases that will reward us as patient investors for the next 5 and 10 and 20 years. This is the time to be patient. This is not the time to be fearful, and definitely not the time to lose your nerve. And when you hear everyone being really pessimistic, smile to yourself and let them carry on, because they're helping you drive prices down so you can buy assets at great prices.
Oh, sounds good. It does. You really picked us up this evening. Personal finance with Warren Ingram from Galileo Capital. Warren, we'll speak to you again next week.
Thank you so much.